contract volume for selling put options is what we are discussing in this video, my friend. At the 30-second mark of this video, I'm going to have a link popping up right here. So in about 9 seconds, a link to a video that will let you in on the unfair advantages of selling cash secured put options on stocks you'd like to own. Right there, it just popped up. I put it at the 30-second mark, so it'd be easy for you to remember. And at the 1 minute mark, there's going to be a link to this playlist. This playlist has 5 videos in it, and it will give you a good basic rundown of how to set up an account with some charts and some general terms and things like that. And it'll also introduce you to the wheel strategy, which I'll be talking about. It's going to be popping up in about 4 seconds. Get ready for it. Right there. Boom. There it is. So we got something at the 30-second mark. We got something at the 1 minute mark. Watch both of them. Don't watch any of them. Like, look, I don't know you. You don't know me. So I have no idea why you're watching this video. I'm assuming you're watching this video because you're trying to learn how to make some money in the stock market. And what you don't have to assume and what you can just 100% know about me is that I believe if you have an internet connection, a bank account, and you spend money at least once a year, you got no legitimate reason not to be selling cash secured put options on stocks you'd be happy to own. So this website, this YouTube channel is dedicated to me doing something to feel like I'm giving back to my fellow human beings, helping out to help you learn a strategy that has changed my life for the better. And I think it'll do the same for you. We got free stuff. We got paid stuff. And you don't have to have any stuff. But again, there's that link to the unfair advantages of selling cash secured put options on stocks you'd be happy to own at the 30-second mark. That was right up there. There's the link to this playlist here at the 1 minute mark of this video. And anytime I'm referring to the wheel strategy is explained in that playlist. And what were the other? Okay, so I think the next part is what we're going to do is disclaimers. So first disclaimer, this is not financial advice. These are not stock recommendations. These are not trade recommendations. In fact, the ticker symbols that we are going to be talking about are these any of these 12 different sector ETFs. I do not personally trade these. I don't know if you should be trading them. And that is why I picked them, because they're not suitable for me. They're not suitable for you. In fact, you know what's suitable for you more than I do, but maybe you don't know what's suitable for you right now, so you need to learn. You need to contact your priest, your attorneys, your presidents. You need to contact everybody that tells you what's good for you so that you can learn those things. Or you could do what I do, and you could just say, what? Other people know what's better for me than I do myself? That's BS. I'm going to figure out what's the best for me. That's what I recommend you do. But you know what? You do what you want to do. And that's what this channel is all about, my friends. It's not about taking the water and putting it in the horse's mouth. It's just about pointing to the water and say, there it is. You can drink if you want. And then Brother Brent's drinking. Because that's the way it is. Okay, so not financial advice, right? You get it. We're just going over mechanical things that I'm going to be showing you and talking about. I don't necessarily do it exactly like this when I'm using real money. Some of the stuff we're just kind of doing for educational purposes, and you want to be more on point. You want to be more dialed in when you're doing it for real. So don't copy any of these trades. They're not financial advice. We're just kind of educationally look at mechanics of things. The next thing we need to discuss, practice with paper trades, right? This is a paper trading account, simulated trading. You should be using a paper trading account. You should be practicing. For example, if you were going to join the fire department, do you think that the fire department might have you put on all your gear and bring jump into the fire truck, bring it to a predetermined building that was not on fire, and put the ladder up and have you climb up there and have you, I don't know, go in and take one of your coworkers, do the fireman carry, and bring your coworker down the ladder, so you'd be simulating saving somebody's life before you had to do that with a real fire. Because if you can't do it when there's not a fire, you think you're going to be able to do it when there's a fire? You know, the time to learn little things like you don't want to learn how to put your belt on when the fire is burning the baby up. You want to know how to put your equipment on without thinking about it. You want to know how to put your equipment on as a second nature before the stress of real risk is there. It's the same with the stock market. But you know what the difference is of the stock market and the building burning down? The building burning down doesn't make you money. The stock market does. So our mind can get kind of cloudy with greed. And we can start trying to fire off all these real trades because we think we're going to become Ray Dalio in the next 20 minutes, and we're going to basically be a billionaire in the next 30 days and not going to work any ever again in our lives. So all of a sudden we're stock market geniuses. But you probably wouldn't do that when it came to fighting a fire, right? You'd be like, oh crap, maybe I should practice this a couple times. So same thing here, right? Do the same thing. Paper trade. I'm paper trading. Now, I'm the trades like this, I don't, even though I'm paper trading here to show you, I don't paper trade these anymore because I know how to do them pretty well. I do these, I'm seriously doing these in my real account, but I'm just not using these ticker symbols. But I am doing this stuff day in, day out. I'm always doing this trade. I will practice other trades that I don't have mastery of. I'll practice those in paper trading accounts to try to figure out the dynamics. But this one I got dialed in. So that's what my recommendation to you. We're going to be looking at contract volume for selling put options. Once we go over some of those things, we'll come back in and I'll explain to you what's going on, what's the updates with these stocks that I've been working on here. So stick with me to the end of the video. We'll go over that. And in the meantime, let's talk about contract volume. When I think it was 2007, I believe it was 2007, Invest Tools was making its way through Honolulu. They were running a lot of classes. And I went to as many as possible. And one thing that I distinctively remember from Invest Tools is they had said, with the scanning feature, the first thing that I don't know if it was the first thing they said, but it's one thing. It's one of the first things I remember, is they were saying to trade, when you're doing option trades, trade underlying ticker symbols that have an average volume of 500,000 shares or more per day. So if it had like 100,000 shares traded on average per day, they said don't do that. They said go with 500,000 or more shares traded per day. So here we're looking at the SPY, S&P 500 ETF. This is really easy for you to use. It's free. I would suggest creating a free account. Sign in, get yourself a free account. And I'm sure you have a cell phone. The Yahoo Finance app is really great. You don't have to log in. You can just like quickly pop it up and have a list of stocks that you want to look at. Anyways, this is obviously on the desktop, but you go to finance.yahoo.com, put in your ticker symbol. Like for example, I put in SPY. Boom, hit here. I click that button. It pulled up, and we got the average volume right here. So with SPY, the average volume is a little less than 80,000 shares. On the last day it traded a little bit over 92,000, right? So if we're looking for stocks that trade 500,000 or more, this one definitely is significantly over that. So that's the underlying ticker, but let's look at the options on SPY, the volume on the option contracts. For this, we're going to be looking at the 12 days to expiration. And the reason why we're looking at that is these contracts right here got 12 days to expiration. No other reason than that. It's kind of arbitrary. So right here, this is your option chain. I don't know if it's your option chain or my option chain or the option chain, so just give me some slack on that, whoever has ownership of the option chain. Anyways, on this side, right, we got the put side, we got the call side. Down here in the center is the date. You notice it's going to be the same date. When we close this, these are all different dates. These, what's in parentheses here, that's how many days to expiration. This is the actual contract day. Me personally, this is not a right or wrong thing, but I'm pretty focused on how many days to expiration. So I kind of pay less attention to the actual date, and I start just looking at how many days to expiration, and then I look at the actual date as a default. So that's just how I do it. You do it however it's best for you. Okay, so now down here is the strike price. And you notice on the put side, it's black over here, and it's black over here. Kitty corner over here on the call side. This black part is out of the money. And this purplish part is in the money. See where this changes color? You could say that's at the money. Somewhere in here is like at the money. And this is can be referred to as the moneyness. How close to the moneyness is it? So now we're going more out of the money, and now we're going more in the money. And it's vice versa here. Now we're going more in the money, now we're going more out of the money. So let's just take a look at right here, near the money, open interest volume. This is how many contracts traded the last day on Friday. And I think open interest is how many total contracts maybe were traded since this contract opened. I'm not 100% sure on that one, but I know this one is for the day. This one is longer than 1 day, and between the two, I can have a pretty good idea of how much volume, how much demand, what's the liquidity of this particular contract. And look, it's in the thousands. All these are in the thousands, except for this one right here, and that one, right? Okay, there's some other ones, right? But overall, it's a lot in the thousands. Very, very, very liquid, right? So let's take a look at XLF, which is a ETF for the financial sector. Okay, average volume a little less than 50 million shares traded per day, less than SPY, but it's still a good amount. Very, very liquid. And let's do the same thing over here. XLF. Look at this, not nearly as much, right? Not nearly as much. We got 1,000 here, we got 1,000 there, but other than that, they're like in the hundreds or less, right? Not nearly as liquid. Let's take a look at one that is not going to be very liquid at all, and that is XRT, retail ETF. Well, pretty liquid here, right? Still meeting the InvestTools criteria of over 500,000 shares traded, right? We're at 5 million. So the actual underlying is very liquid. But what about the option contracts? XRT. Look at this. Wow, minuscule. Not much volume at all. Not much open interest. Hardly any contract volume on this one. Now, why would this matter? Well, depending on what type of strategy that you're doing, the open interest and volume on the underlying and on your option contracts, depending on what type of strategy you're doing, may make more of an impact. For example, if you are, let's say you're buying debit spreads, and you might not know exactly what that is, and that's okay. So let's just look at some of the key, one key word in that name, buying, right? Buying. When you buy to open, you pay, and then what's the next word? Buying debit. That means money is flowing out, right? So you're buying and debit. Money is flowing out of your out of your account. So when you're buying a debit spread, in order for you to make money before expiration, you need to sell to close before expiration, and you need to do that at a profit. When you're buying a debit spread or buying a vertical, which is basically the same thing with different name. When you're buying a debit spread, in order to make money before expiration, you need to sell to close at a higher price than you bought it, right? Buy low, sell high. So if you really don't have much volume, you might not be able to sell to close. You might not even be able to buy to open. You probably can buy to open. There's probably going to be someone willing to take your money. Vice versa. If you're trying to sell to open, you might have a hard time selling to open, right? So if you're going to be selling a credit spread, which, you might let it expire worthless. It's outside of the realm of what we're doing at I Have Success. And one reason why it's outside of the realm is that when it makes it a little more, it makes it a little more complicated. Like when you are doing certain option trades, you definitely have to be aware of what's the volume of these contracts? What is the liquidity of these contracts? And for that reason, this is another reason why I really love selling cash secured put options on stocks that I'm happy to own. Because I don't have to worry about it as much. You notice I said as much. I didn't say I don't have to worry about it at all. I don't have to worry about it as much. This one, I definitely would not be doing the wheel strategy on XRT. Even though whether I'm doing the wheel strategy or whether I'm accumulating stocks for like a forever buy and hold in my dividend portfolio, I still would like a little bit. I would like a little more volume, because what can happen? What can happen is that if there's no volume, you might never get assigned, or it might just take forever. Excuse me, not get assigned. You might not get filled. Right? If there's just no one having interest in this, to sell, you need a buyer. And if you just want to sell, no one wants to buy, your contract is not trading hands, and your position will not be opened. So it is something to kind of consider and to keep in mind. But you don't necessarily need this type of liquidity when you're doing doing the wheel strategy or selling cash secured put options on stocks that you would be happy to own the rest of your life. You don't need this type of liquidity. In fact, you can definitely, this type of liquidity will probably be sufficient for either one. Because generally speaking, what's going to happen is that you're going to open these contracts and you're not trying to close them. You're just going to let them expire worthless. So as long as you can get opened, it doesn't really matter about the expiration part. Now, when I do the wheel strategy, though, I would like to have higher volume on the option contracts. One certain stocks that I'm going to be doing the wheel strategy on, one thing that I'm looking for is that they have some decent volume on them, just in case. That not only does it make it easier to get filled, because generally when I'm doing the wheel strategy, I'm selling a lot more contracts more often, but also just in case something goes sideways for some reason. Now, you might say, well, why not the same thing with, in your dividend portfolio? Because really, I just really don't care, to be honest with you. That's really it. I really don't care. When it comes to the dividend portfolio, I'm generally selling the covered calls out of the money far enough that if I got called out, I'm going to be happy with the capital gain. For example, if I bought a stock at $32 and I'm going to be selling, this is one I wanted to have for the long term, I'm probably going to be selling covered call in this time range right here, about 12 days. Somewhere like maybe 5 delta or less. What does that mean? Generally speaking, selling 5 delta means you got about a 5% chance of it getting assigned. So if I bought it at 32 in a 12-day period, you know, I made some money on the premium, and it went up to $34.50, and I made $2.50 per share. Yeah, I might take that, and then just start selling cash secured put options again. So I'm just really not worried about closing out these contracts myself. Now, maybe you want to do it a little bit differently. You know, I am definitely not saying that the way that I do it is the way that you should do it and it will make you the most money or anything like that. I'm not saying it. I'm not saying that. I'm saying it works really well for me, fits into my lifestyle, and fits my lifestyle being that I live in the Hawaiian Standard Time Zone. I work a pretty hectic schedule, and it fits into my lifestyle. And what I am saying, I'm saying that, and for you, what I'm saying is that you take this information and you play with it in your paper trading account, and you figure out what's going to work for your particular situation. Right? Be your own coach. Figure out what works best for you, and use the paper trading to help yourself determine that. So what's the black and white answer for option contract volume when it comes to selling cash secured put options on stocks that you'd be happy to own or doing the wheel strategy? Give me the black and white answer, Brent. Well, it is the accounting answer. It depends. The black and white answer is it depends. Depends what you're doing, depends what you want to do, depends on a whole variety of things. And so I guess the most black and white answer is play with it and figure it out what your black and white answer is going to be. And don't rely on the suspect opinion of other people's black and white answers for that particular thing. Let's take a look at what's happened here in this paper trading account. So I think it was last Friday, maybe last Saturday. I can't quite remember, but towards the end of last week, I think it was after market close, I put an order in to sell a 162 put on XLK, this technology ETF. 12 days of expiration, and I think I had to adjust it. I think my original order was a lot higher. It didn't get filled. I think I adjusted it. It got filled. I got filled at 37 cents here. It's got about a little bit less than 15% chance of getting assigned. And right here, you can see that if I were to close this out right now, I'd be losing about $9. But I'm not going to be closing it out. This contract is going to stay open until it expires. And regardless of what happens at expiration, I'm keeping this $37. It's either going to expire in the money, and I keep this 37, and I take ownership of 100 shares of XLK at $62 per share, or it doesn't. Or XLK is over $62 upon expiration in 12 days, and it expires worthless, and I just keep the $37. So I have no plans on closing this out. I'm just going to let this ride, and whatever happens is going to be okie dokie for me. Again, I'm going to reference that video at the 30-second mark of the beginning of this video. The unfair advantage of selling cash secured put options on stocks you'd be happy to own. And this will be explained in better detail about what happens and how the money and the asset flows through your financial statement when you're doing this. On this one, XLU, which is a utility ETF, I did get assigned, right? I sold a put option at a $67 strike price. I can't remember how much credit I brought in, but I got assigned. So now you can see here, quantity 0, quantity -1. That means I sold. I'm short one contract here. This means I have none of the underlying asset. This means I have 100 shares of the underlying asset. And I sold another cash secured put option at the $64 strike price. That one has about a little bit over a 34% chance of getting assigned. and I sold a covered call option. If you don't know what a covered call is, if some of this stuff is getting confusing, at the 1 minute mark, there's that playlist. So go through and watch that playlist. It'll explain a lot of these terms. Also, it'll explain the wheel strategy, show you how to set up some charts, things of that nature, and how to use the Yahoo Finance to screen for stocks. So I got a covered call, which is basically I have a commitment to sell 100 shares of XLU at $68, and I have 100 shares to sell. I bought them for $67. So if I sell it for $68, I'll make $100 on that sale. I got paid $20 for that promise. So just by looking at that, I'll make $120. But if that happens, which there's only a little more than a 10% chance of that happening, if that happens, this one will be expiring worthless. So I make another $25 here. Now this one, you see though, this one has a higher chance of happening. So more than likely, this one is going to expire worthless. This one may or may not expire worthless. And if XLU goes below 64 upon expiration, then I'll be taking ownership of another 100 shares. If that happens, I will have a -2 instead of a -1. I'll be selling 2 covered call options. And let's say XLU stays above 64 but below 68. Then both of these will expire worthless. I'll keep my 100 shares. I'll sell another put option and another call option. And if I feel like it, maybe I'll just buy another 100 shares so I can, sell another call option. If it's starting to make sense or seem kind of simple, the reality is it is pretty simple. You know how people will, actually maybe this is not simple, but it's easy. Sometimes, especially in the multi-level marketing world, they love to say it's simple, but it's not easy. You ever heard anyone say that? Oh, it's simple, but it's not easy. And there are some things like, maybe like knocking someone out with a jab. Like, it sounds real simple, right? You just punch them. But it's not that easy. And so same thing with multi-level marketing. Same thing with a lot of business stuff. It's a simple business model, but it's not easy. Well, this is the reverse of that. This is easy, but it's not simple. The reason why it's not simple, because you have to know, okay, I don't know if you have to know, but let's say it behooves you to know what delta is, what theta is, what probability of in the money is, what the mark is, what the trade price is, what expiration date is, how many shares are in one contract, what's a put option, what's a call option, how do you pick a good underlying stock, what is an underlying stock, and that type of thing. As we're also have been discussing, what sort of option contract volume is going to be good for you. But once you know these things, what's nice about this strategy is that, yes, there's a lot of stuff to know, but it's not an infinite amount of stuff to know. For example, I spent about 5 years being a professional massage therapist. And I went to a school. When I went to school, I went to the school that at the time it was the best school that Honolulu had, and was 1 year long. And I remember one of my instructors was telling us that the wonderful thing about memorizing the names of all the bones in the body is that there's only like 200 of them. And next year, there's not going to be 300. It's like the same amount of bones have been in the body for all these years. When I looked at it that way, I was like, you know what? That does make a lot of sense. Because what if I just memorized one bone per week? Hey, it's going to take me 200 and whatever weeks. What if I memorize one bone per day or whatever? If you can really it makes it more manageable when you realize it's not constantly changing. And overall, that's kind of how the strategy is. It's like there's a certain amount of things that you need to know, but once you know them, yeah, what changes is the stock price, maybe a little bit of the option premium and stuff like this. But overall, you got to check your underlying stocks and things like this. But there's really not more things to learn per se. So it ends up being easy, But it's kind of complex to learn all these terms and figure out what's going on. But overall, it's easy. Like for me, it's a bread and butter strategy. No matter what's going on in my life, I continue to sell cash secured put options on stocks that I'd be happy to own. Right? That's not the. I don't feel the same way for doing butterflies, doing iron condors, doing any type of spreads, iron flies. I don't know, anything. All these other trades out there, I don't feel the same way about. Even though, like, theoretically, iron condor, yeah, it makes sense, but how do you adjust it? And you have to pay a little more attention to it. Basically, one of the things I love about this is, like, upon expiration date, it just doesn't matter what happens. I win no matter what. So if you want to learn a trade where you win regardless of what happens at expiration, I got a couple action items for you. First thing is go back to the beginning of this video and watch the link at the 30-second mark, the unfair advantage. Really start letting it sink into your mind about how beautiful it is to win regardless of what happens at expiration and what that does for your financial statement. And then after that, watch the playlist at the 1 minute mark. That'll give you some basic terms. Yeah, there's still more stuff you need to learn, but it'll give you some basic terms, show you how to set up some basic some charts, so at least you got a general idea of how to set something up. More than one thing, set some things up, and I show you how to do it in a way that I don't really do it myself anymore, but it's a great way to as a beginner to learn. Show you how to use a MACD or a stochastic, and I don't really use MACD or stochastic anymore myself. I don't prefer to, but definitely in the beginning I did, and sometimes I'll throw it on there. Just I think I might got it somewhere in here, maybe not. I can't quite remember. Nope, not on this paper trade account. Anyways, my friends, that's what I got for you, and you guys have a fantastic day. Get out there and do some paper trading. Learn these strategies because, wow, you can do it from the comfort of your own home, and it might take some time to get this stuff under your belt and get a grasp on what's going on. But if you put the effort in, it will be life-changing for you, and I want you to experience that. Aloha.